Hello, everybody. Welcome to a brand new episode of Geeked. Today I'll be talking about chapter number 3, financial planning. What this chapter talks about will be mostly ratios. In fact, I've got 5 different categories of ratios. We're also going to look at something called the DuPont Analysis and standardized financial statements. I've created an Excel spreadsheet that looks at 2 kinds of standardized financial statements. This chapter is fairly straightforward. If you've read it before or this is your first time, it shouldn't be too hard for you to understand what I'll be talking about today. So starting with financial planning, different categories of ratios here: liquidity ratios, asset management ratios, debt ratios, profitability, and market value. So what are liquidity ratios? What is liquidity anyways? Liquidity usually talks about debt upcoming within a year. So we're looking at current ratio that examines the company's ability to pay off its current liabilities, its current assets by current liabilities. How about quick or asset ratio? Current assets minus inventory by current liabilities. To give you an example of that, so if I got a firm with a current assets worth $3,000, inventory $1,700, and current liabilities at $2,000, what is the current ratio? It's 1.5. But what does that 1.5 tell me? What does that number signify? All it really says is your company will be able to pay off its current liabilities. They'll be left with $1,000. So anything over 1 typically means that you'll pay your current liabilities you'll be left with a bit of assets, current assets. Quick ratio in this case is 0.65. Okay, looking at asset management ratio analysis, what do asset management ratios tell us? They tell us how each class of assets compares to projected sales, or how is it when we compare the two, sort of link them together, how well do they stand? If I expect to sell $10,000 worth of inventory, for example, and I've got $9,000 worth, is that a good thing? Is it maybe too low? Should you have a bit more? Should you have 11,000 in case you sell more than projected? Or should you have 9,000 in case you sell less than projected? What happens if you end up selling 10,000? It also looks at different classes of assets. It also looks at how well the firm does in managing its working capital. So there's 5 different asset management ratios: inventory turnover, sales divided by inventory, days sales outstanding, average payables period, fixed asset turnover, and total asset turnover. Just a little trick here, something that I use personally to help myself remember these ratios. For turnover ratios, you're often found with the sales being in the numerator and that first term or that first asset class being in the denominator. So when you look at inventory turnover, it's sales by inventory. Fixed asset turnover, sales by fixed assets. Total asset turnover, sales by total assets. Okay, as for debt management ratios, what do we mean by debt management ratios? We talk about how much debt financing or financial leverage is the firm actually using. 3 different kinds here. Debt ratio, which is total liabilities by total assets. Debt to equity, which is total liabilities or total debt by total equity. Time interest earned is EBIT divided by interest charged. So how many times the interest charge are we earning in operating income? That's all it really is. Okay, profitability ratio analysis. How profitable is the firm? We're looking at net profit margin, which is the net income, divided by sales. So how much net income do we have to earn for each dollar of sales? Operating profit margin, EBIT by sales. How much operating income do we have to earn for each dollar of sales, or do we earn for each dollar of sales? Gross profit margin looks at sales minus cost of goods sold divided by sales again. Basic earning power is EBIT divided by total assets. Return on equity and return on assets are very similar here. Return on assets is net income by assets. Return on equity is net income by equity. So market value ratio analysis. Does the current stock price reflect the firm's value? Anytime we talk about price in ratio, we're usually talking about the stock price, the price that you see in the market. So price to earning ratio is a big ratio in the financial industry. Simply put, it's stock price by earnings per share. Price to cash flow, stock price by cash flow per share. Market to book value is stock price by book value per share. And book value per share is calculated through common equity divided by shares outstanding. On to the DuPont analysis. So if you've noticed when we were going through the slides, I've got a few formulas written in bold, like total assets turnover and return on equity, return on assets. So let's go back to the DuPont analysis slide. To break it down, all a DuPont analysis really does is breaks down the return on equity equation into 3 different elements. My job here is to explain to you how these 3 elements are derived, or how do we come up with these 3 different elements. We're going to start off with return on equity equals to net income by common equity. If you break that down a little bit, you'll have return on assets multiplied by equity multiplier. And now if we were to break down ROA, since return on assets is profit margin multiplied by turnover by total assets turnover, we can replace those 2 elements. In place of return on assets, we'll have 3 different elements. Return on equity equals profit margin multiplied by total assets turnover multiplied by equity multiplier. And I've got the expanded version underlined right here. So all you have to do, remember that. Return on equity equals PM times TAT times EM. Profit margin multiplied by total asset turnover by equity multiplier. Okay, now this is our last slide, but this chapter is not over yet. I've got standardized financial statements. As I've discussed earlier, we will be using Excel for that. So standardized financial statements. There's 2 different kinds of standardized financial statements. We're looking at common sized analysis right here, and we're looking at percentage change analysis. I'll start off with the easy one here, percentage change analysis. What is percentage change analysis? What does it mean? So for this one, I want you to remember one thing. Remember this formula. I've learned this from a finance professor, and it's something that you will use for a very long time. New minus old divided by old. So just get rid of the equation right here. So new minus old divided by old. This is all we use for percentage change analysis. So when we look at this element right here, we're looking at the 2015 number minus the 2014 number for sales, and we're going to divide that by the old, which is 2014 in this case. So you will do that across the board here, and that is what you will be getting. So again, all this really means here is you're comparing the change from the old year, 2014 in this case, to the new year, 2015. So when we have 8.05% right here, what does that tell us? It tells us cost of goods sold have gone up by 8.05%. Let me see if I've got a negative somewhere here. Yes, I've got a negative right here. So minus 0.93% in short-term debt. What does that tell us? Short-term debt dropped by 0.93%. Okay, our last concept here for today's chapter is common size analysis. What is that? What does it mean? So common size analysis is a bit different for income statements and balance sheets. For income statements, you're looking at dividing each number by your total assets. So right here for 2015, by your number of sales, I apologize. Dividing each element by the number of sales here. So when we look at sales divided by sales, you get 100% here. When you look at cost of goods sold by sales, you're looking at 51%. So you'll do that across the board. Each one of these elements is divided by sales. Okay, this is a little bit different for balance sheet. Each number is divided by assets, by total assets. Proof of that is your total assets are 100% because they're divided by total assets. So again, just a brief cover right here. A brief coverage of these elements. When you look at income statements, common size income statements are divided by sales. Okay? Common size balance sheets are divided by total assets. As for percentage change analysis, very simple. You're dividing new minus old by old. So 2015 minus 2014 by 2014. This will be all for today. I'd like to thank you for your attention. Thank you for watching this video. I hope it helps you learn this chapter very well. I encourage you to go over each equation, study it, and if you have any questions, please feel free to contact me through the email I've got in the description box or by commenting on this video. Thank you for your time once again, and I wish you all best of luck on your studies.